Today, I'll be talking about 3 Canadian dividend stocks that you should have in your portfolio for 2021 or at least on your watch list. What's going on, guys? Welcome back to the channel. If you're new here, my name is Jason, and if you haven't already, what are you waiting for? Hit the subscribe button down below so you don't miss out on future videos like today. And just a tiny disclaimer, I'm not a financial advisor, so whenever you're buying into a company or investing, always do your own research and consult a professional. This video is only for entertainment purposes only. And with that being said, let's jump right into today's video. First one on the list is a telecommunications company here in Canada called Telus. And for those of you who are not familiar with Telus, like I said, they're a telecommunication company in Canada that provide a wide range of telecommunication products and services such as internet, voice, entertainment, healthcare, video, and IP television. And we're going to dive deep into Telus to see if this is a good Canadian dividend stock to have in your portfolio. Jumping right into Telus's 1-year chart, and you can see here last year during the pandemic, they took a steep dive and they tumbled down about 28%. But since then, they have made a comeback and are up 33%. And during the recording of this video, Telus's market cap is sitting at $34.249 billion. And they have a beta of 0.56 with a PE ratio of 25.58 and an EPS of 1.04. And Telus also pays a pretty good dividend of about 4.73%. And now, if we take a look at the earnings, this is where things take a turn. Because if you look at Q4 of 2019, Q1 of 2020, Q2, Q3, they have been continuously missing their earnings expectations. But don't let this drive you away from having this company in your portfolio. And if we pull up their annual financials, you can see here they have been doing good since 2016, increasing their revenues year over year, and their earnings have relatively stayed flat. And the same thing goes when you go into their quarterly financials, because their revenue pretty much stayed the same quarter after quarter, and along with their earnings. And looking at the recommended rating by the analyst for Telus, currently it's sitting at a solid 2, which is a buy. And the average analyst price target for Telus is currently $27.20, where currently the stock is sitting at $26.55. And currently, Telus is down about 4% from its recent high. And looking at their average revenue estimates for the next year, they're looking at about $16.42 billion in revenue. And if you take a look at Telus's growth estimates for next year, they're looking to grow about 12.60%. And comparing that to their growth estimates for the next 5 years, they will be growing about 3.40% year over year. Now, this may not seem like a lot of growth potential, but I'll go over that in a few seconds. And as Telus grows over the next few years, and I do see them growing at a bigger pace than just 3% a year. Because just in 2020 with the whole pandemic, Telus did make a great progress in attracting new customers to diversify their wireless and wireline products. And Telus has been consistently rated with some of the fastest, most reliable internet and data service in the world. And this has actually helped Telus produce very strong, stable cash flows, even despite the pandemic and the craziness that we went through last year. And Telus has also been investing in other businesses that you may not even know about, because they own Canada's largest telehealth business, and they also operate Telus International, which provides business digitization automation services for everything from call centers to IT networks. And Telus has also recently expanded into the agricultural technological solutions. And I feel like with Telus, they're so well diversified that it does not actually reflect in their stock as of yet. And I feel like this company is very cheap from where they're going to be in the future. Number 2 on the list is also a Canadian company, and it's called Sunlife Financial. And Sunlife Financial is primarily known for life insurance, and it's one of the largest life insurance companies in the world, next to Manulife. So let's dive right into Sunlife Financial and see if this is worth having it within your portfolio. Jumping straight into the 1-year chart, last year with the pandemic, Sunlife Financial did see a dip of almost about 47%. But since then, they have managed to recover about 70%. But overall, since their last highest price, they are still down about 9%. And at the time of recording this video, Sunlife Financial does have a market cap of $35.517 billion, with a beta sitting at 1.02 and a PE ratio of 15, along with the EPS of 4.05. And just like Telus, Sunlife Financial also pays a dividend of about 3.62%. And if we compare Telus's earnings and Sunlife Financial's earnings, you can see here they've been beating their earnings expectations consistently. And looking at their annual financials, you can see here 2016, 2017, 2018, they relatively stayed flat in revenue, but in 2019, it spiked up a bit. But if we switch to the quarterly financials, you can see here in Q2 of 2020, they had a big spike of revenue, but then in Q3, it dipped down. And taking a look at what the analyst recommended rating is for Sunlife Financial, currently it's at a 2.4, which is a buy. And the average analyst price target for Sunlife Financial is sitting at $62.33, where currently Sunlife Financial is sitting at $60.71. And looking at Sunlife Financial's average revenue estimates for 2021, they're expected to generate $41.15 billion in revenue. And as per their growth estimates for next year, they're expected to grow about 8.20%. And over the next 5 years, they're expected to grow 7.70% per year. And as we can all agree, 2020 was definitely a rough year for companies, especially Sun Life and along with the rest of the financial sector. So it may seem like a slower recovery, but if you're in it as a long-term investor, you'll definitely see this turn around and become even better over the next couple of years and be very beneficial to your portfolio. And Sun Life Financial is aggressively investing into Asia because about 20% of Sun Life's earnings are generated from the Asia region, which includes the Philippines, Hong Kong, Indonesia, Vietnam, Malaysia, India, and China. And last but not least, the third company that we're going to look at is called Fortis. If you're unfamiliar, Fortis is a utilities company and they operate in Canada, the US, Central America, and the Caribbean. So let's find out whether or not Fortis should be a part of your portfolio for the long term or not. And jumping straight into their 1-year chart, we can see last year during the pandemic, they ended up dropping about 28%. But since then, they have managed to recover about 22%. But overall, they're still a little short because they are down about 13%. And currently, during the recording of this video, Fortis has a market cap of $23.885 billion with a beta of 0.06, a PE ratio of 19.29, and an EPS of 2.65. Just like the other two companies that we talked about, Fortis also pays a dividend of about 3.96%. And looking at their earnings, you can see here, they're kind of all over the place because one quarter, they'll beat their expected earnings, the other quarter, they'll miss them, and the other quarter, they'll meet them. But if you switch over to their annual financials, you can see that their revenue has been staying consistent and their earnings have been increasing. But if you switch to their quarterly financials, you can see Q2 and Q3 of 2020, their earnings have relatively stayed the same. And currently, the recommended rating for Fortis by analysts is 2.5, which is a buy. And the average analyst price target currently sits at $59.50, where currently they're way below that at $51.17. And looking at their average revenue estimates for 2021, they're expected to have revenues of $9.62 billion. And looking at their growth estimates for next year, they're expected to grow 10.50%, and over the next 5 years, they're expected to grow 5.25% year over year. The majority of the revenue that Fortis makes comes from regulated assets, and this pretty much means that their cash flow tends to be reliable and predictable because as homeowners and as companies, they need to keep the lights on and heat their buildings and their homes. So this way, Fortis has a reliable revenue stream. And if we compare their net income of Q3 of 2020, which was sitting at $302 million, and comparing that to the same quarter last year where it was sitting at $287 million. And Fortis's current 5-year capital plan of $19.6 billion is expected to boost the rate base from $30.2 billion in 2020 to over $40 billion by 2025. And also taking a look at their dividend payout, in 2020 it was sitting at 5.8%, and they do intend to increase the payout by an average of 6% per year through 2025. So if you're a long-term investor in Fortis, you should have no worries about getting paid by dividends. And in my opinion, Fortis is a great investment to hold in your portfolio for the long term. And I hope you enjoyed today's video. If you made it this far, be sure to hit the thumbs up button by now because it does help with the YouTube algorithm and it helps support the channel. And if you haven't already, make sure you hit the subscribe button down below and become a part of the growing community here. And that being said, I will see you guys on the next video.